Hi, everyone. I'm Frank Malika with KTVU Fox 2 here in the San Francisco Bay Area. My guest is a leading national economist, chief economist of Bank of the West, and here to talk about our economic recovery and what lies ahead. Say good morning to Mr. Scott Anderson and good afternoon. How are you, Scott?
I'm good. Thank you for having me on.
Well, good. I'm glad you're good. Our economy obviously needs a little work, and I was looking over some of the numbers. They don't look very good right now, do they?
It's really depressing to be an economist right now. We're looking at probably the worst recession since the Great Depression. That's how bad the numbers are going to look in the second quarter. It's really going to be off the charts of anything I've seen in my 20 plus years as a chief economist at a major bank.
I know 6 million jobless claims forecasted for this week alone, to bring it to about 17% unemployment. I mean, we haven't seen those numbers since the Great Depression, right?
That's right. We don't think the unemployment rate will peak until it hits around 20%. So that was just shy of the peak we had during the Great Depression when the US unemployment rate hit almost 25%. So we're going to be in that ballpark at least for a few months here before we restart the economy and people start to come back to work. But this is going to be a broad-based, very deep, very sharp downturn. And what's making this so artificial right now and is so hard for economists to forecast is it is artificially driven this time. We've basically shut down our economy, or a vast majority of it, almost overnight. And we've never seen anything like that. You have to go all the way back to the Spanish flu pandemic period of 1913 to see anything that even approaches this in terms of impact on the US economy. And back then we didn't have a lot of good economic data. All we had is industrial production data back then, but even then we saw a 3-year downturn for the US economy with a 30% decline in industrial production growth. So we're looking at least something of that magnitude this time around.
Yeah, and we're dealing with something, an illness that Lord knows when it's going to be over. Will it come back? And the fact that we don't have this is going to end in December. I mean, it must just throw everything kitty wampus.
There's a lot of uncertainty about how long. I mean, a lot of economists are debating what shape the recovery is going to take. Are we going to see a V-shaped bounce in the third and fourth quarter, second half of this year, or is it going to be something more gradual, more like a U or even an L-shaped downturn? It's really unclear, and it really depends on how the virus, if we get a hold of the virus, if we are able to open up our economy and extent that consumers and consumer confidence comes back. Our models really don't give us a good handle on how that's going to play out. So what I'm telling our management and what I'm telling our customers and clients is the drop is going to be so steep that it's still going to take probably a couple of years just to get back to where we were. Even if it is a nice bounce in the third quarter, it's going to take us a few years to get back to where we were in terms of unemployment and GDP growth.
And even still, I think our habits are going to change. Obviously, the way we greet people, the way we socialize, the way we go out to dinner, we go to a ball game or jump on BART. A lot of these things we took for granted as just part of our way of life are going to change. That's going to have an effect as well, don't you think?
I really do. I think this is, I think the markets and the stock markets had a nice rebound in the last couple of weeks.
Yeah.
I think investors are still really underestimating how fundamentally this is going to change everybody's daily life and the way companies are operating. And that just doesn't mean profits for companies, but also, how many people are going to be going into work or working from home. That could change fundamentally for forever. So yeah. I think we're in one of these moments that our children, people that grew up during the Great Depression affected their behavior their entire lives. I think we may be in for something like that this time.
Well, here we are at home working away. I work at home 3 days a week. I really, the retail industry that are brick and mortar, I feel for them. J.C. Penney's has been around for over 100 years and likely is going to go down. Are people even going to go to malls anymore? Are they going to buy everything online? And real estate. I mean, there's got to be some people here in San Francisco that are saying, why do I need 100,000 square foot of real estate space in the Salesforce Tower when I could send half of my employees home and they're just as efficient?
Yeah, that's just a great example. I mean, it's really hitting really hard right now where we're seeing most of the layoffs and furloughs are in places like leisure and hospitality,
Mhm.
airlines, hotels, retailers, restaurants. But it's going to be really broad based how many people are impacted by this. I'm enjoying working from home right now, but not a lot of people can benefit from that. Only about a third of the U.S. workforce has that capability. But I think more and more companies are going to be looking at this as a possibility going forward. So I really do think commercial real estate is going to get rethought, and some of the valuations we're seeing in the city of San Francisco might look pretty steep in a few months' time.
I bet, and I bet rents go down among even even homes if you're trying to sell your home right now. Let's talk about the Fed because they've really stepped up. They're doing a lot. I've got a quote here from Jay Powell, the Fed chief. He said, I'm going to do everything in my power, forcefully, proactively, and aggressively to bring back our economy." And they have stepped up a lot, but I guess a lot of people are wondering, where's all this money coming from?
It really is the Fed's do whatever it takes moment. Mario Draghi, the head of the European Central Bank, had a similar moment during the last Great Recession, financial crisis. They're basically throwing everything but the kitchen sink at this monetarily. They're trying to set up liquidity and loan facilities that are going to help businesses of all sizes, including small businesses up to medium and larger firms, to an extent we've never seen before. They're offering about $2.3 trillion worth of loans and liquidity to these companies so that they don't continue to lay people off over the next several quarters. We're hoping that people will come back after these shutdowns. But it's a grand experiment. They're going beyond anything that we saw during the financial crisis and the Great Recession, which at the time nobody thought we'd ever see anything like that again in our lifetime. So here we're back into a 1 in 100 year event, both financially and economically. But I will give the Fed credit. They've rolled out these programs very, very quickly. They've calmed some of the financial markets down. Just a week or two ago, we were seeing
Yeah.
500-point swings or more in the stock market. We were seeing strange things happening in the bond markets, and people were even selling ultra safe U.S. Treasury bonds just to cover, I think, their losses in other areas of their portfolio. So it was very, very unusual. We saw spreads widening out. So the fact that the Fed has stepped in here so aggressively has helped calm things down a little bit. We're not seeing the panic, at least, but we're still going to have to live through the economic implications of this and the profit implications of this for
Which may be
companies.
around for a while. Now,
Yeah.
are all these loans, they got to pay them back, right? Or are some of them forgivable?
Well, the ones that the Fed are offering are going to have to be paid back. But as you know, the CARES Act that the federal government passed, I think 2 weeks ago, to the tune of about 2.2 trillion in terms of support for the economy, has loans that are could be grants if small businesses repay those loans. So we call the Paycheck Protection Program, offers about 350 billion in lending just to small businesses. And right now they're facing the brunt of these impacts. And from my understanding, some of the money that's been offered may end up being already used up by this Thursday.
Oh my
So
God.
the Congress is actually looking at more in terms
Sure.
of expanding this program to 500 billion or even more if needed.
Can you give us a little Econ 101A? It's been a while since I've been at Cal, but are they printing money? I mean, can the federal government just say, take it? I mean, eventually that's going to cause, I guess, inflation, right? Our money won't be worth as much. How does that all work?
They're creating money out of thin air. It's not like they're running a printing press in the back of the Federal Reserve building, but they can create money by creating accounts at the Federal Reserve that the banks can use to lend out, and that's what we're seeing happening with these loan programs. So they are creating money almost out of thin air. The downside of that is, and economists have studied this for centuries, is that because other governments have caught on to doing these sorts of programs in the past. We call it monetizing the debt, where you're basically printing money to fund your economy, grow your economy. eventually that's either got to be paid back or you pay it back through inflation and a weaker currency. So there is going to be some downsides to all the things that the Fed's doing right now
Uh,
economically.
I know you're an economist. I'm sure you invest as well. With the stock market, with the crazy highs, the crazy lows, we got down around 18 and change, 19 low, and then back up to 24. Were you surprised that it bounced back? It seems like, I know we've been doing stuff to kind of settle things down, but we still have the big issue out there.
Well, I think investors have been kind of trained over the last 7 years of the expansion to buy the dips, right? They've always been
Right? Oh,
rewarded
sure.
as they do that. And so I do think it's a little premature. It's not unusual, though. You tend to see these in bear markets where you'll see a big steep sell-off. And at one point, we were down 35% on the S&P or even more on the Dow. And we come off that significantly. But I'd be surprised if that continues from here. I think we're all going to see this deluge of bad economic data. We're starting a new earnings season where we're going to see a lot of warnings. We've already had the banks come out, and we're seeing billions of dollars of excess reserves for loan losses being put out there. So I think there's a lot of bad news ahead of us that the investors are going to have to get through.
Well, as a baby boomer, not quite ready to retire, but I could see it out there a little bit. What advice would you give someone like myself, or maybe someone that's in their mid 60s that kind of had the nest egg put away, figured they'd sell the house, and now all of this change? Might we see Americans working maybe longer now, till 70?
Yeah, I mean, it took us almost 10 years to work our way out of the Great Recession, and we've seen that already where older workers have stayed in the workforce longer, and it's been harder for those just entering the workforce to enter the labor market. So this will just compound those issues, and so hopefully your portfolio was positioned conservatively going into this. You want to, in this sort of environment, you definitely want to be diversified between stocks and bonds and even foreign assets to try to weather these storms. But I think everyone's going to take some hit on their IRA and 401ks, and again, it could take years before we get back to the highs we saw just a few
I
months
think
ago.
everyone's owned personal ATMs the last 20 years has really been real estate. If you own a home and you sit in it long enough, you're going to make some money. You want to make improvements, get your kids to college, and the Bay Area, boy, do we know that. I moved from New England. I hate to tell you, the house, I had 3.5 acres in a 4,000 square foot home on a Tahoe type setting, and sold it for 400,000 and moved back here in 2011. And my realtor almost started crying. She said, "Oh, well, we've got a fix me upper, but it's about 40 miles out of San Francisco." And I'm like, "What?" Um, what do you think about real estate prices? Are they going to finally come down? Especially, I mean, probably all over the country, but they're pretty inflated here.
Yeah, residential real estate is definitely, come kind of to a screeching halt right now. We expect sales and even home building to drop at least 40%, 50% on an annualized basis in the second quarter. The question is how fast do we bounce out of that? The good news is this time around, everyone remembers the Great Recession when home prices dropped, almost 30% nationally. Um, this time around, we don't expect as big declines in home prices, though I do think we will, especially here in the Bay Area, see some price drops, at least 12 months from now. But going into it, households were in better financial shape. There wasn't as much leverage in the mortgage market. People had been a little more conservative in taking out mortgages. They certainly weren't doing these no-doc mortgages that really were popular right before the last recession. And the other thing is home builders have been very cautious in building housing this time around. So here in California, in the Bay Area, there's been actually a shortage of new homes being built. There's been much more demand than supply. So those are some somewhat stabilizers as we go into this. But I would imagine we are going to see, probably for the second time since World War II, we're going to see a decline in home prices, both here in the Bay Area and nationally.
And how about industries? Which ones do you think are going to have the hardest time? Clearly, cruise. liners, but is it airlines? Is it restaurants? Is it in sporting teams? I mean, the Giants have an empty stadium. The A's have an empty stadium. I mean, the Warriors just opened up the Chase Center, had an awful year. And then sadly, it's even worse now. I can't even have a concert there. Who do you think is going to have the most difficult time climbing back?
I think it's going to be restaurants and bars. I mean, it's the small business owners, really, the mom and pop shops that really don't have a lot of extra capacity to weather something like this. The bigger companies, even if their sales and revenues are down, like the airlines, I think airline traffic was down 96% from where it was a year ago, just
Ridiculous.
last month. That's going to be painful, but these are big billion-dollar companies that have lines of credit and can tap the bond market and find other sources to get them through it. It's the small businesses where they really are going to need this money that's coming from the federal government just to survive and be able to reopen. The disaster would be if these businesses have to close more permanently. They've already, a lot of them have cut at least half of their staffs, and those that are still employed, they're taking pay cuts and wage cuts. But there's always this hope that in a few months they'll be called back. If they close their doors for good, then we're looking at a multi-year. And then you really got to think about the possibility of a depression forming here with 20% unemployment.
Right.
We're talking about a multi-year, even maybe a decade long of recovery ahead of us.
Well, you think if a restaurant closes, then some landlord's losing, you know, a renter who's in there, and then he's got to answer to someone. It's amazing how it all kind of trickles down.
Yeah, you get this cascade effect, a negative feedback loop is what economists call it. And like I said, we're just in the early stages of that. I mean, all we really have to hang our hat on here for an economic forecast is really these jobless claims data we're getting. And today we got some retail sales and industrial production data for March, kind of the first sign of the downturn, and it was historically bad. Some of the worst drops in retail sales and industrial production on record, going all the way back to the 1940s.
Yeah. Well, I got another stat. The California Restaurant Association said unless they get major help, probably a third of the restaurants in California won't come back, which is pathetic.
That's what we're concerned about. And I'm a little bit more in the U-shaped camp. I do think we could bounce and growth could restart maybe late in the third or early in the fourth quarter. So officially the recession will be over at that point. But in terms of getting our economy back on track and seeing, double-digit gains, I really don't think that's likely here. I think consumers are going to gradually come back to the stores and restaurants, but I mean, I think we may have to keep the social distancing for a long, long time until we get a vaccine.
Take out half their chairs. They can only serve so many people. People might have to wait outside to come in. You might have a waiter with a mask on and gloves. I go to a place here in the city, Campanina. I actually just interviewed the owner about an hour ago, and he's a hugger. You walk out, Frank, how you doing? Come in, your table's over there. That's over, right? Probably.
Yeah, it's really going to change fundamentally, and that's like I said, it's something that, and from a bank perspective too, we're really trying to be there for our customers and help them weather this storm. But the banking industry hasn't been what it once was either. Rates are low, banks aren't making a whole lot of money on every loan they're making, so it's really. We're going to be relying on the federal government and the Fed more than we ever have really since the Depression.
Scott, what brings you hope? What is there a silver lining out there in our economy? Will we learn from this? Is there some goodness out there?
Yeah, no, absolutely. I mean, we haven't lost fundamentally what makes this country great and what makes our economy great. People are very inventive, innovative. We still have Silicon Valley and the technology industry is really benefiting from some of this dislocation in other industries. We're relying more on technology. I'm talking to you right now on Zoom.
Right.
We're all working from home remotely. So this is, some of these systems that we've been putting in place and that, the Bay Area have been inventing now for more than a couple decades are really going to be utilized more than ever globally. And so those are going to continue to be growth areas. and very profitable areas for the U.S. and for the Bay Area.
All right, I like the way you're thinking. He's Scott Anderson. He is the chief economist for Bank of the West, and I want to thank you so much for sharing some insight with us, Scott.
Thanks for having me. It's been fun.
All right, I'm Frank Malakote here with KTVU Fox 2 in San Francisco. Back to you.